Okay, so chapter 8 is all about receivables. And the chapter focuses on two particular types. The main focus is on accounts receivable, because that's a very important aspect to understand. And then this chapter has a section, Learning Objective 3 is dedicated to notes receivable, something that's also very, very important. So again, understanding what they are and how they are valued. So how they are recognized, accounts receivable will have to be recognized. And then again, these show up on the balance sheet, which means they have a value. And just like inventory, where we can't value inventory above what it's really worth, we have to do the same thing with accounts receivable. Because just because someone owes you money and that's your receivable doesn't mean they're going to pay. Most businesses do pay, but there's a few that obviously during times like this, they go out of business, so they can't pay. So there's ways in which there's measures that we have to take to make sure that the value of our accounts receivable on the balance sheet is accurate. Mm-hmm. And then, of course, once we decide that something is not collected or collectible, we have to go through this process of identifying what we call a bad debt. And so you're going to learn about that. A little bit on notes receivable, and just a little bit is Learning Objective 3. And then we're going to learn a little bit of financial analysis, because, what is a chapter nowadays without a little bit of financial analysis thrown in? So you're going to hear a little bit more about that in Objective 4. First and foremost, just to understand, there's lots of receivables actually on a company books, and your text sort of introduces you to some here, these other receivables. There's a lot of them. But for our discussion, our main focus of this chapter is accounts receivable, right? Which are owed from customers because we sold them something and we gave them an invoice. And so we're waiting to collect, waiting to receive payment for something we've already sold them. And then you're going to learn a little bit about notes receivable, because some of these customers need more than 30 days to pay. And so we turn it into a loan. Remember, the word note means loan. Okay, there's interest attached to the word note. There's a due date, etc. Whereas receivables, there's no interest. Accounts receivable, no interest. It's usually due in 30 days. You don't have to worry so much about all these other receivables, but your book does explain a little bit about just how big a category receivables can be. Some companies have a lot of accounts receivable as a percentage of their total assets. If you look here, we were talking about automobiles prior. Ford Motor Company, GE here, I don't know when this was done in terms of the data, but they have a large percentage of their assets tied up in receivables because of the structure of that industry. Ford Motor Company makes the automobiles. They'll sell them to a distributor. Distributor's not paying cash for all of those vehicles. So Ford Motor Company has a lot of receivables. Okay. And so, and that's why it's so high here. It's a percentage of total assets. It's just the way that industry is structured. But as you see, depending on the type of company, they're less dependent on those types of things in terms of percentage of assets. So you know how accounts receivable is recognized. Most of this book, we've talked about Sierra Corporation, which is a service organization, right? They do tours. When they do a tour on account, that means they earn the revenue, but they're waiting to receive payment. So that's an accounts receivable. Right? For a merchandiser, normally speaking, you and I cannot walk into a Walmart or any other store and just take stuff and say, okay, I'll pay you later. Or we could, but we end up in jail on shoplifting charges. But, the idea is that this idea of how a merchandiser has a receivable, it's usually because they're dealing with other businesses. Here's an example. My dad was an electrician when he was working and had a small little company. Uh, when he would get a, look for, when he would get a job, he would go to the electrical supply store. He would go there as a business. The electrical supply store knew that my father was, in their eyes, a business. And so they gave him all the supplies he needed for a job, and they gave him a bill to pay. So that's their receivable. That was my dad's payable, but that was the electric supply company's receivable. That's how receivables are done. They're usually business to business. It's not, it's very, very, very unusual for you and I to be able to walk into any type of a merchandiser, buy a whole bunch of stuff, and tell them, yeah, give me a bill, I'll pay you later. Okay. We have to pay cash or we use our credit card, but the credit card is a cash sale to the business. Okay. It's a loan for us, but it's a cash sale for the business. And so credit card transactions do not count as receivables. They are cash sales to the merchandiser. So that's important. Okay. You also knew that when a merchandiser does sell things on account, because you saw a whole bunch of that in chapter 5, they often offer terms, right? 210 net 30 to help collect that receivable quickly. And of course, the buyer might also return stuff. And so you have sales returns and allowances for that company. All of those are going to affect the receivables amounts for business to business transactions for a merchandiser. So your book has a couple of illustrations here real quick. Jordache sells merchandise on account to Polo on July the 1st. It's $1,000 of merchandise, 210 net 30. So clearly Jordache is going to record this on their books as a accounts receivable debit, because they're waiting to receive that, and a sales revenue credit. Right? So that's how they would show it. Right? When if they a few days later, Polo returns merchandise, so you have sales returns and allowances debit, receivable credit. So here you see that receivable has now been reduced from $1,000 to $900 because of this return. Right? They're not expecting to collect $1,000 anymore. That receivable is now $900. So this is part of the issue with receivables, is that they change frequently for merchandisers because of sales returns. If the company who you sold it to takes advantage of a discount period, that's also going to show up here, because you're going to have, you're bringing in less cash, right? In this case, 2% less is $18. So that sales discount is going to be debited along with the cash to fulfill all $900 of receivable that you were expecting. Okay. But still, this $900 of receivable is technically only valued at $882 in cash, because that's the actual cash value of the receivable. So this is going to play into that next part. Right? Just because someone owes you $900 doesn't mean that it's actually worth $900. Okay. So this is one of those types of things that we think about. Okay. Yeah, some companies do issue their own credit cards. Actually, that's really not an issue anymore, because a lot of companies basically partner with banks and let the banks, they outsource that. They let the banks basically be their credit arm. So I'm not even going to go over this particular part with you, because it's just not something that happens as often. And so this do it exercise about recognizing receivables should all be very, very familiar for you from chapter 5. Here we have on May the 1st, Wilton sold merchandise on account to Bates for 50 grand. The terms are a little bit funky, 3% in 15 days, or the net amount in 45 days. Okay. So here we're recording the sale with the accounts receivable. Obviously, a few days later, they returned merchandise for 2,000. Sales returns and allowances gets debited. Receivables get credited. So now we only have 48,000 of receivables that are owed. And then, of course, they're going to take that discount because they paid within 10 days. And so here on the 16th, we're going to record $46,560 of cash on $48,000 of receivables. The $1,440 is the sales discount. So was your receivable, even though it might be on your balance sheet as $48,000, is it really worth $48,000? No. So this is going to be the focus of chapter 2, right? This is really what it's worth, cash value in essence. So this is part 1. No real big deal about learning objective 1 here. The big deal in this chapter is learning objective 2, because this is how we have to understand that companies have this issue of valuation for accounts receivable. Accounts receivable is an asset. It's a current asset specifically, right? So if it's going to be on the balance sheet, it has to be as accurate as possible. Remember, the principle of conservatism. We cannot value our assets at a higher price than what they actually are worth. Okay. You saw that with inventory, with the lower of cost or market, as a way to say, look, this is what our inventory is really worth, right? Conservatively speaking. Well, guess what? We're going to do the same thing in receivables. They just have a different method of doing that. Okay. So you're going to learn about something called an uncollectible account, because not all the receivables, again, these are business to business transactions. Not all those receivables are going to be able to get collected. Okay. So let's say, back in February or March of this year, you were a business doing business with other businesses and you had receivables with them. And some of those businesses were affected by COVID and they couldn't pay the bill. Well, how do you handle that? Well, now that you've recognized that there's a possibility that the account may not be collected, we have to go through a process that gives us what we call a bad debt expense. Okay. When you extend credit to other businesses because you give them a bill and you're going to receive it later, you're in essence extending credit to them, right? Because you're going to get paid for that later, but you're giving them the merchandise now, but get paid later. And again, a lot of things can happen in 30 days. And what if they can't pay? Right. So for a business who cannot collect on their receivable, now they just can't give up because they're a day late. No, they have to try their best to collect. That's another thing they have to do. Right. But they can recognize certain efforts as not fruitful. They're not going to collect. And thus, from a practical perspective, that becomes a bad debt expense. It's a cost of doing business because it's a little bit of a risk that they took to extend the credit by giving merchandise on account or selling merchandise on account. And that risk didn't pay off in a payment. So businesses are allowed to have what we call a bad debt expense. There's a couple of methods that accountants use to value the receivable. Okay. Small businesses can simply directly write off. This is write off, not write of, write off, write off method. And because direct write off is not compatible with GAAP. It's not compatible with GAAP. But if you were a small business that did business with other businesses and thus sold merchandise on account, and they didn't pay, and they told you they're not going to pay, you can simply write a bad debt expense that day and take their receivable off your books because you're not going to receive it. So why keep it there longer than it has to be? So that's something small businesses can do. Corporations, public corporations, because that's really the focus of GAAP. They have to do something, they have to use something called the allowance method. And what they do is they estimate every year based on past years, because most businesses have been in business for a while. Based on past years, what percentage of receivables are not collected? Or they can actually use another calculation method to find that number. But according to GAAP, they can only have a bad debt expense once a year. That's at the end of the year. And it's an estimate. It's an estimate. And you'll see that play out. Okay. So this is one of those things that's required by GAAP to use the allowance method. And that's what you're going to be learning here. So what you usually see on the balance sheet is you'll notice accounts receivable is the asset. It's a current asset account. What we actually have to create right next to it is another contra asset account called the allowance for doubtful accounts. It's a real account, allowance for doubtful accounts. Okay, it's sort of like that accumulated depreciation account for equipment. It comes right after the equipment account on the balance sheet. Right. So here, allowance for doubtful accounts actually comes right after the accounts receivable to show how much of their receivable they do not think they're going to collect. They have allowed as bad debt. Okay. That's basically what they're doing here. So you just learned about the allowance for doubtful accounts. It's a real account. It comes right after the accounts receivable account. So it's an asset account, but it has a credit balance. So it's a contra asset account. Just like the accumulated depreciation account is a contra asset account. So what we have is $500 of receivable for this corporation. And they have estimated or allowed for $25 of that to be bad debt. So this $25 has already been written off as a bad debt expense in the last year's income statement, which means that the real value, what we call a net realizable value of accounts receivable, is the difference between their actual receivables minus the allowance. Okay, so this is the number they actually use to value their receivables on the balance sheet, because this number is a conservative estimate of how much of this they're really going to collect in cash. Okay, so that's the allowance for doubtful accounts, and that's how it looks on the balance sheet. A lot of balance sheets will not necessarily list the allowance account underneath. They'll actually use a phrase called net of. So this $475 on their balance sheet already includes the 25 allowance. Okay, which means the actual receivable is the 475 plus the allowance is the actual amount in the accounts receivable account. But again, this 475 is a conservative estimate of the real value of accounts receivable. And that's what the allowance method provides for corporations. Again, specific for corporations and public. I'm not going to go over this piece because, again, way too much detail for us to know. But we will, and again, I'm not doing direct write-off because it's not something that can be used in a public corporation. But how it works is if you have a company that has identified a debt account on a certain date. So in this case, this company has identified the account of M.E. Doran, okay, who owes them $200. And they don't think they're ever going to see this because they've tried. they simply can write it off that day. Okay. Bad debt expense for that day. And that removes the account off of the receivables. Why I mean, again, this money is still sitting in accounts receivable and it's not going to be collected. So why have it sit there once you know who it is that's not going to pay you? You want to remove that account. So they do it with a direct write-off method simply by expensing it on the day they have identified with certainty they're not going to be collecting it. Now that's a direct write-off method, which is not something we use, okay, because there's no matching. Not accepted. What we have to use, according to GAAP, is the allowance method. And as I mentioned, it's a yearly process. Companies have to estimate what's uncollected, okay, or what they consider uncollectible. The estimate is usually based on previous year's numbers. As the most, I mean, they use two different methods, as you'll see. Okay, what they do at the end of the year, and only at the end of the year, is they'll debit their bad debt expense. Excuse me, once. That's it. It's a one-time thing. They will credit the allowance for doubtful accounts. So that money, even though it's expensed that year, that money is still sitting in that allowance account. So as they identify people or companies who are not going to pay them, they take the money out of the allowance account and technically write off that company's receivable from their books. They take it off the books. So that's the process that they have to go through for a corporation. So here's what they do, okay? This is a good illustration, and you'll see this type of illustration on your homework as well. A furniture company, Hampson Furniture, has credit sales. So this is an interesting term because I don't think it's been used before. A credit sale is simply a sale of merchandise on account. That's it. So a company comes in, buys office furniture from them. They deliver that office furniture with an invoice. In other words, they pay me later. That's a credit sale, sale on account. Okay. And again, for business to business transactions, it's relatively common to have a credit sale or a sale on account. So credit sales mean a sale on account. So in 2017, they had $1.2 million of credit sales, quite a lot. Obviously, that's for all of 2017. So some of this happened in January, February, March, et cetera. So obviously, all credit sales are usually due in 30 days. So they've been collecting these regularly. However, at the end of the year, because we're at December 31st, 200,000 of this amount is still uncollected, which means it's still sitting in accounts receivable. Okay. The credit manager has come up with an estimate that $12,000 of the receivables are going to be uncollectible. And so it's December 31st. They're going to close out with a bad debt expense for $12,000. And they're going to move that $12,000 into the allowance for doubtful accounts, right? Credit side. What do the allowance of doubtful accounts do? It'll shrink the receivables on the balance sheet to get to the number that they think is more accurate. So how does it look on the balance sheet? $200,000 of receivables, subtracting out their allowance for doubtful accounts of $12,000. This is what we call the net realizable value of receivables. The amount of receivables they actually are hoping to collect, subtracting out their allowance for uncollectible, gives them a conservative value of their receivables, net realizable value. So 3 months later, it's March, same company, Hampson Furniture, they've identified a $500 balance owed by a client are aware. So you can look at it a few ways. They are aware that they're not going to collect this, or they're asking, where is this guy's money? Anyway, either way you want to look at it is fine. But on March the 1st, they have identified this client who owes them $500. This guy's not going to pay. Okay. So now they want to make an entry to take his $500 out of their receivable. They do that by taking the money out of the allowance account and closing out this guy's receivable on their accounts receivable. So a debit to allowance takes the money out of the allowance, and a credit to receivable closes this guy's receivable. Okay, now they're not expecting any money from him because they closed his account out. So what happens is, once they do this entry, it's going to post into their respective places in the ledger. You'll see that the accounts receivable account has been adjusted by $500 on March 1st, right? That's the closing of the where account. So the balance in receivables is $199.5, but they took that $500 out of the allowance account. So the allowance account is now down to $11,500. The difference between these two numbers is still $188,000. It's still the exact amount shown here on the balance sheet. Okay. And that's one of the benefits of this system. Well, sure enough, and this happens sometimes, July 1st coming around, guess what? This guy, R.A. Ware, shows up and says, look, I just went down to New Jersey and played a casino. I hit it. I have the $500 to give you. Okay. Well, the company had already written this guy off in March, but he shows up with $500. They're not going to say no. Okay, they'd be idiots to say no. So they say, okay, fine, we'll happily take your $500 to pay off your account. They're not going to tell them that they wrote him off. Okay, because they're very happy to collect the cash. That's what accounts receivable is supposed to be anyway. It's supposed to turn into cash. So what they do on July the 1st is they reestablish his receivable. They put him back on the books. And they move that money back into the allowance account for some other schmuck. Okay. And then they do what they really wanted to do in the first place. Take the cash to pay his receivable. Because this is how receivables are supposed to be paid. That's what you're looking forward to. An accounts receivable will get turned into cash in 30 days. That's what you're hoping for. Right? Obviously, with this guy, it took a lot longer, but at least they got the cash now. Why would a customer like R.A. Ware want to pay a bill like this after so long? Does this happen in life? Yeah, it does. The reason someone would want to reestablish their relationship with the supplier is because they're back in business there and they want to do business with that supplier. And to show good faith, because they know they did something wrong, they want to pay everything up and say, look, I'm sorry, I had a hard time, but I'm back in business. Here's the payment. And I want to reestablish a good relationship again. Now, that doesn't mean that we're automatically going to be giving this guy lots of merchandise on account now. We might still do business with them for a while as long as he pays up front. But if he keeps doing that after a period of time, you could probably build that trust back up to say, okay, we'll give you the merchandise on account again. So it might be in this person's business interest to pay that bill. Okay. So again, every company has to disclose in their financial statements, in their annual report, exactly how they estimate their allowances for doubtful accounts or uncollectible accounts. So you'll see that in every single annual report. So there's two ways that they estimate. Okay, the simplest way is simply to take a percentage of their receivables. Okay, they've noticed, for example, over the last 5 years, 2%, an average of 2% of receivables have not been collected. So they'll go ahead and say, look, we'll just do the 2% of receivables, and that's going to be our estimate of our bad debt this year. Okay, that's the simplest thing to do. That is the simplest thing to do. Okay, so that's that. The more complex thing to do is actually a little bit more accurate. In some cases, it is much more accurate. And it's something called an aging. And you've seen me age over the last few months, but this is a different type of aging. This is basically when they list every single customer in their receivables. Remember, accounts receivable is a total of all the customers that owe them money. And they're not looking, all that money is not owed by one customer, right? That doesn't mean that you have a very good business model if you only have one customer. So you have probably hundreds and hundreds of customers that owe you receivables. So you list them out, and the amount of money that they actually owe you is the total. Okay. So this guy, A Dirt, owes them a total of $600, right? $600 of a total receivable of $39,600. A Dirt is $600 of that. Bortz owes them $300, right? $300 of the total amount. Carl owes them $450. Diker owes them $700. Ebert $600, and all the others would be listed, would equal the rest. This is the total amount of receivables this company has. Okay. So you know how accounts receivable works. Customer comes in, to business customer. You give them the merchandise, you give them a bill, right? You're waiting for 30 days to collect. So a lot of these things are not yet due. Okay. So of the 39,000 in total receivables, as you see, the vast majority of that, 27,000 of this, the due date hasn't come yet. Due date hasn't come yet. Okay. That's true for Bortz. That's true for Diker. And that's true for most of the others. But as you see, here's where it gets very interesting, because these are the folks who have missed their due date. And again, most of the time we can go back to the terms, 210 net 30. Net 30, 30 days you are supposed to pay. That's the expectation. Well, what if you are late? That's past due. That's past due. So they break this up into number of days late. If you're only late a little bit, 1 day to 30 days after they were expecting that money, which was the case with $300 for A Dirt and $200 for Carl and $5,200 for all the others. Well, you're not going to really kind of be all that concerned because, you know, realistically, who hasn't missed a due date, right? Doesn't mean they're not going to pay, but it's a possibility that the chances go up. So you see that in the percentages listed down here. They believe that 4% of the folks who are late, the amount, is going to end up being bad debt. That's their estimate. That is twice as high as the folks that aren't due. They're expecting only 2% of these folks not to pay, or a total of $540 of 27. But you see it doubled here. Just because they're 1 to 30 days late, the chances of them not paying go up. Well, what if they're 1 to 2 months late, 31 days late to 60 days late, 1 to 2 months late? Well, thankfully, there's not a lot of them. Only $3,000 of the 39,000 is in the category of 1 to 2 months late. But as you see, now they're expecting that really increases. They think that, wow, probably 10% of this we're never going to see. So they've estimated that $300 of that 3,000 they're never going to be able to collect. That's their estimate. It gets worse when you're 2 to 3 months late. Thankfully, it's a little amount, only $2,000 of the 39,000. Again, this is the total, is 2 to 3 months late. But now it's up to 20%. Look, it's 10 times higher than normal, 5 times higher than being a little bit late. Okay. So again, it increases because, again, the longer you're waiting for your money, the less likely you're going to get it. So 20% of that means they expect $400 of this 2,000, which is already this late, never to be collected. And this is your worst case scenario, right? The folks who have not paid in over 90 days. As you see, it is almost the same amount, $1,900 of the 39,000. So it's and look, they're expecting almost 40% of that. They don't think they're ever going to collect. Okay, so this is the amount. So they simply add all these numbers up, and this total becomes their bad debt for the year. Okay, this total. Well, it actually becomes their allowance. It actually becomes their allowance. It might also be the same as their bad debt, as you'll see. But look at this. I want to know, I mean, personally, if I'm looking at this, I'm looking like, who's the idiot that keeps selling dirt stuff on account? I mean, this guy hasn't paid us in months. Why do you just give him more stuff? So this is a problem for me. Right? So yeah, add all these things up, you got it. Okay, you got it. As you see, it's more complex to use an aging, but it might be accurate. So remember, you have assumed now, based on that, that your allowance, which is all that is, this is what your allowance is going to be. This is your allowance, 2,228. You have said that should be your allowance. Well, sometimes the allowance for doubtful accounts at the end of the year already has a balance in it. In this case, your allowance account already has a $528 balance. You want the balance to actually be 2,288. So you can't write this amount off twice. You wrote that off the previous year. So you simply can only write off the difference. So your bad debt expense actually becomes the difference between what's already in the account and what you want the account to be. Okay. And that's based on the aging. So your bad debt expense for the year, at the end of the year, again, notice all these are end of the year entries. $1,700 debit to bad debt expense. You're going to adjust allowance $1,700. Again, this credit plus the credit that's already there is going to equal this amount that you want, 2,228. That's why you can only expense the difference. Whatever you've come up with as a balance, this is going to be your balance. If there's already money in there, you can't ignore it. Right? It's almost like that your glass already has liquid in it, and you ignore the liquid and you pour yourself a full cup. You just can't do it, right? Because then it's going to overflow quite a bit. So this is, in other words, this is sort of the limit. Once you actually do that calculation, that's the limit in the allowance account. So you can only adjust for the difference. Okay, you'll see it here. The bad debt expense, easy to explain as it gets posted. The allowance account, this might help you. You already have $528 in there. You have calculated this is what you want in there. That's your total allowance, 2,228. You already have 528. So you can only adjust it by whatever you need to get it to the new number. Okay. You only adjust it by what you need to get it to the new number. So that's what you have to remember when you do this. And you're only doing a few. Okay. So let's take a look at your bad debt expense. Do an exercise 2 here. You have Brule Company. They've been in business for 5 years. They have an unadjusted trial balance for receivables at $30,000. Sales revenue, $180,000. This is interesting. The allowance for doubtful account, $2,000, but it's on the debit side. That's unusual because you always want your allowance account to be a credit balance. Okay, so that's the starting point in the allowance account. Bad debts are 10% of receivables. So 10% of receivables, is 3,000. So in other words, if you look at the ledger in the allowance account, you got $2,000 sitting on the debit side for the allowance account. What you want is 10% of receivables, which is a $3,000 credit balance. That's what you want in the allowance account. Okay. How do you get it from a $2,000 debit to a $3,000 credit? Well, a $5,000 credit wipes out that 2 and leaves 3, which is what you're going to need. So what you can do that particular year is expense $5,000 for bad debt, because that's what you're going to adjust your allowance account for. Okay. That would be the adjusting entry in the allowance. Again, this is the allowance account here. I can't really write. Okay. One thing that receivables can be used for, again, sometimes you need the cash now, right? And so technically you can actually sell your receivables. There are companies that specialize in buying receivables at a discount. The company is called a factor. Okay. And a factor is a finance company or a bank that specializes in collection of receivables. Okay. So they technically buy the receivables from the businesses, but they charge a commission. Okay. So the companies get the cash, but they have to pay a commission. So in other words, they're not getting all of the cash that the receivables are worth. But at least that's one way they can get cash if they need cash. Because some companies go through periods of time when they're short of cash. So what does a company do when they're short of cash? Well, sometimes they get a line of credit from a bank and they borrow money from the bank. Okay, that's one way of getting cash. This is simply another way of getting cash, is they sell their receivables to a factor and they collect the cash. Again, they're not going to collect as much cash as the receivables are worth. So what do they do with the difference? So here's an example. Here's another furniture company. They have 600,000 of receivables that they have sold to federal factors. That's the factor. They charge a 2% fee for that. So in other words, $12,000 fee to buy those receivables. So what does the furniture company have? Well, they're going to collect $588,000 of cash for selling 600,000 of receivables. That $12,000 is simply going to be expensed as a service charge. Okay, so they get the cash that they need, but it costs them money. Anytime you need cash, if you don't have it, it's going to cost you money. So if this is their best choice, they'll do it. They'll factor off their receivables. They'll sell their receivables. That does happen. One thing to understand is credit card sales are cash sales to the merchandiser. In order for a merchandiser to accept a Visa or MasterCard, Discover, all the others, they have to be part of that network. To be part of the network, they agree to pay a fee for whatever prices that they charge. They know that every time they accept the credit card, Visa, MasterCard, what have you, they've also accepted that they're going to pay a fee to the network, to the Visa, the MasterCard, network to be part of that. Okay. But again, it's recorded as a cash sale to the retailer or the merchandiser. Okay. The fee, as you'll see, will be expensed. This is huge for retailers because they'd rather pay a little bit of fee than go ahead and do a whole credit investigation of every customer that walks in and wants to buy something. Right. They can, they make it the issuer of the credit card is the one that maintains all the paperwork and the accounts. Right. It's the issuer that goes over all the collection and other types of stuff. The merchandiser doesn't have to deal with that, which means they get cash a lot more quickly with less hassle. So this is the proliferation of Visa, MasterCard everywhere. Okay, almost everybody takes it. Okay. So this is how it works for a business. Let's say Morgan, who owns a restaurant, buys a lot of music, $1,000 worth of music from this music company, Soundgroff Music. She uses her Visa card. Sonderoff Music pays a 3% service fee every time a customer uses the cards there. So Sonderoff Music is going to record this as a cash sale of $970 on $1,000 revenue. And they're going to expense the $30 fee as a service charge expense. Okay. And that's basically how credit card sales are viewed. Okay. So again, factoring is selling off of receivables for cash, but there is a service fee. There's a service fee. So here's an example where you have a wholesale company who needs $120,000 cash now to cover payroll, which I think their employees would appreciate. Okay. So this is their need. They need cash, 120. They have receivables on their balance sheet of 750, right? So they don't have to sell all of them, but they decide to sell 125,000 of them to a factor. Okay. That helps get them the cash they need to make their payroll and one less worry. Again, they're going to pay a 1% service fee for that sale. So what's it going to look like on their books? Well, they're going to receive $123,750 of cash, which is more than enough to cover their payroll, right? But they're going to have to record a service charge expense, which is 1% of the sale of their receivables. And of course, those receivables are now off the books. They have sold those to the factor. Okay. All right. Any questions so far? How are we doing? All right. Couple things left. Learning objective 3 here is about notes receivable. Okay, we're going to go over this pretty quickly. You already know that a note is a loan. It's a promissory note. It's a written promise to pay. It has an interest rate. It has a deadline or a due date, things like that. So how are notes receivable born? Usually because the companies who have an accounts receivable need more time to pay. So this is the main reason notes receivable are born. Okay. So I have a notes receivable. I have an accounts receivable with company X. Company X says, look, I know it's been 30 days. I know I owe you the money now, but I just don't have it. I need another 60 days to pay. And I'll say, fine, we will change it from an accounts receivable to a notes receivable. I'm going to charge you interest because I have to wait another 60 days for my money. And this is going to be the due date. Please sign. And they say, okay. And boom, you have a notes receivable. It's that simple. It's that simple. Okay. So this is what it looks like. There's a payee and there's a maker. Okay. So in this case, to the maker, in this case, Brent, it's going to be a note payable. To the payee, in this case, Wilma, it's going to be a receivable. So this is, again, to pay an accounts receivable. So here you have $1,000 made on May the 1st, 2017 for 2 months. So when it's in months, it's simply you count May 1st, June 1st, July 1st. That's when it's due. Okay. What's due? The $1,000 is due plus interest. The interest is 8% annually. So we have to break this down into the 2 months because this 8% is for a full 12 months. And they're going to owe only 2 months of interest on this. Okay. And that's basically a note in a nutshell. Okay. So again, the maturity date is the due date. It's the due date. Everything is paid on a maturity date for a note. The loan and the interest are all paid on the same day. Okay. Notes can be structured in months or days. So if it's months, it's like what you saw on the previous slide, 2 months, 3 months, 4 months. But sometimes notes are actually for a number of days, in which case they use multiples of 30. Okay. So it's either going to be 30 days, 60, 90, 120, etc. Okay, that's how they view it. The most important thing to learn here is how they calculate interest on these notes. Okay, so it's the actual note or loan itself times the annual interest rate, because again, this is annual, it's all 12 months. And most of these notes are short term. They're for 3 months, 6 months, no more. I mean, it's really very rare. So you have to multiply that by the time in order to get the interest. Now, this time is noted here differently, okay? Because again, notes are either going to be in months, as you see here, or days. So that's going to affect the time. So it's always the face value, which is the actual note, loan, times the rate, which is always an annual rate for all 12 months, or in the case of a note using days, all 360 days, because we're assuming a 30-day month for 12 months. Okay. So you multiply by the time. If it's in days, it's the number of days over 360. If it's in months, it's the number of months over 12. That's typically how those are done. The interest is the amount of interest that's due along with the face value on the maturity date. So they're going to be paying the face plus the interest all on the same day. Whenever that 120 days is up, all of this is due. So $759.20 is due. That's the 730 plus the 2920 together. After 6 months, $1,045 is due on this loan here. The $1,000 face value of this loan plus the 45 in interest, all paid at the same day. Okay. So that's how notes work when you compute interest. So when you actually, in this case, Wilma has accepted the note to settle a receivable, an accounts receivable. So Wilma Company will show that note receivable will pay the accounts receivable for Brent. Oftentimes there'll be a little thing here for Brent as well, right? So this note pays the receivable for Brent. What you need to know too is that notes can either be honored, which means they're paid on time, or if a note is not paid when it's due, we say it's dishonored. That's all. That's all they mean, just terms. Okay. Honored note is paid in full when it's due. A dishonored note, not paid in full when it's due. Simple terms. So here we have an example of an honored note. Wolder lends Higley $10,000 on June the 1st. It's a 5-month note. It's pretty long. 9% is the annual interest rate. So on November the 1st, this note is going to be collected. So how much are they going to collect and how is it going to look on their books? Well, first of all, they're going to be collecting $10,375, right? That's the $10,000 note plus the $375 is the interest that they earn during that 5 months on the note. Now, if you're earning money on a loan, you have to count that as revenue. So any interest that they receive on any notes they have is got to be listed as interest revenue. Of course, revenue is always credit side. Right? So that's basically how they would handle things in the case of this. In the case that actually books close, so they made the note in June, it's not payable till November, they close there, they have a fiscal year that closes September 30th. What do? Well, very much like you saw in chapter 4, right? When you had accrued interest, you would have on September 30th, this is the wrong date, September 30th, they would debit the interest receivable, credit interest revenue, because they have to, again, do all, this is just an adjusting entry for interest that you saw back in chapter 4. So when they actually do collect it, if they have to close their books early because they have a September 30th fiscal year, they would again receive $10,375 in cash. $300 of that would be taking care of the interest receivable that they recorded, and that $75 is new revenue for the new fiscal year. And that's all they're saying here. All right, so here, same thing. There's a few problems that you're going to have to do with notes. It's really about calculating interest. So here is a $3,400 90-day 6% note in settlement of an overdue account. So the note receivable replaces the accounts receivable. All right. The note matures on August the 8th. And what entry does Gambit make? Well, what they do, first thing is you calculate the amount of interest. Again, since it's a 90-day note, the time is 90 over 360. Okay. So 3,400 times 6% times 90 divided by 360, $51 of interest. So when it matures on the 8th of August, they're going to get $3,451 in cash. $3,400 of that is the loan, the note being paid. So the note receivable comes off the books. And the other $51 is revenue that they've earned. Okay, last, we're going to look at two things: how receivables are listed on the balance sheet and the financial analysis of it. And they're relatively quick. You might have heard of this company before. Okay, Deere and Company. They make, lawnmower equipment. They make tractors for farming. They make a whole bunch of things like that. You've probably seen them. They're green with the word Deere on it. And as you see, they have quite a few bucks. They have quite a few bucks in receivables. Okay, little smirk there. They have an allowance for that. They take away a little bit, but at the very end, their receivables still come up to quite a lot of dough. Bucks, dough. Oh dear, I wish he would stop. So I will. Let's go to the financial analysis pieces, please. So I start doing my Deere thing. Two very important ones: the accounts receivable turnover. How many times a year are they collecting their receivables? Well, you would expect that if it's a 30-day receivable, and they would collect at least 12 times a year, because there's 12 months a year. 30 days is roughly a month. So every month they should be collecting, which means if you looked at it over a year's period, they should be collecting at least 12 times. So an accounts receivable turnover really measures the number of times per year that a company's been collecting those receivable. Again, 12 is normal for 30 days. Well, once you've calculated the accounts receivable turnover, you can simply put that number under 365 to actually get the collection period, the actual number of days that they had to wait to collect. So again, you don't want that to exceed the amount that you've given people for credit terms. So 210 net 30, net 30, at 30 days, that's your credit term period. You don't want to be waiting longer than that, right? So these measures tell us about how long they're waiting. Okay. So here is the accounts receivable turnover, which is simply the credit sales divided by the average receivables. So your beginning and ending accounts receivable is averaged out. Okay. So for Nike, here's 2014. Here's the accounts receivable turnover. They had credit sales of 27,799. Looks like they have average receivables around that 3.2 million mark. 8.5 times a year. Well, 8.5 times a year is a little low, right? Because you want to have collected that at least 12 times a year, which, as you see, the industry is able to do. The industry is collecting 12 times a year, which makes sense because they have a 30-day collection policy. They're hoping to collect their receivables every 30 days, which means 12 times a year. Well, Nike is well behind here. Okay. Skechers isn't doing that much better. Okay, they're a little bit better. So excuse the pun, they're running ahead of Nike here on their collection of receivables, 9.6 times, but still not up to that industry standard, 12 times. Well, then once you know that receivable turnover rate, you can put it under 365 to actually get the collection period. That's what the second line is for. So if Nike is collecting 8.5 times a year, and there's 365 days in most years, they're waiting literally almost 43 days to collect a receivable that's usually due in 30. That's a problem. That's a big problem. Skechers, again, not doing a hell of a lot better, but a little ahead in the race here. They're collecting every 38 days. The industry seems to be fine. The industry has a net 30, and they're collecting in 30 days. So the industry, all of those athletic wear, fitness companies are basically about average, except Nike is well behind. Skechers isn't doing that much better. So if I was the head of Nike's finance department, I would bring everybody in and show them these numbers and say, look, this is where we are. 8.5 times a year, that's terrible. 43 days, we're waiting 43 days to collect money we're supposed to collect in 30 days. Please. This is the standard. We need to beat it. And I would just tell them, just do it. Oh, it's a punny day today, isn't it? Thank you, Marky. Very punny, very, very punny. So there's a couple of those little things you got to do at the end. No big deal. No big deal. Financial analysis pieces are reasonably straightforward at this point. Okay, questions?